Imagine two 28-year-olds sitting at the same kitchen table with the exact same problem. Smith opens his banking app, stares at $42,000 of debt, and decides something radical. Every extra dollar he earns is going toward wiping that debt out as fast as possible. No investing, no stock market, no trying to beat the system, just one mission: become debt-free. William looks at the exact same numbers and reaches the opposite conclusion. He makes the minimum payments on his loans and starts investing $600 every month into a low-cost fund that tracks the Standard & Poor's 500 index. His thinking is simple. If the market has historically returned around 10% per year over long periods, why rush to pay off loans charging much less than that? Both sound rational. Both can quote experts. Both think the other guy is leaving money on the table. And here's where things get interesting. If you ask followers of Dave Ramsey, Smith is making the only decision that makes sense. Debt is an emergency, and every day you carry it, you're giving away your future. Ask investing first advocates, though, and they'll tell you William understands something Ramsey doesn't. Time in the market beats almost everything. Every month you delay investing is a month of compound growth you'll never get back. So who's actually right? The surprising answer is that one of these strategies usually does win over the long run, but not for the reason either side argues. Hey, I'm Brian, and I spend way too much time thinking about the financial decisions that quietly shape your future long before you notice the results. If you enjoy cutting through money myths with real numbers instead of internet arguments, make sure you're subscribed, because every week we break down the math behind the biggest financial decisions you'll ever make. Today, we're putting both strategies under the microscope. Same income, same debt, same starting point. Only one decision changes, and by the end, you'll see why the conventional wisdom is only partially right, and why the real winner has almost nothing to do with spreadsheets. To make this fair, we're controlling almost everything. Smith and William are both 28 years old. They each earn $55,000 per year, which is close to what many young professionals earn in the United States. They live similar lifestyles, have similar expenses, and each manages to free up the same amount of money every month after paying their bills. Neither gets a surprise inheritance. Neither wins the lottery. Neither receives a huge promotion. The only difference is what they do with their extra cash. Both owe a total of $42,000. That includes $22,000 in student loans with an interest rate of 5.5%, $14,000 on a car loan charging 7%, and $6,000 on a credit card charging a painful 22%. Every financial expert agrees that 22% credit card debt is dangerous. Where the disagreement begins is everything that comes after that. Smith follows Dave Ramsey's philosophy almost to the letter. He attacks his debts with relentless intensity, paying far more than the minimum whenever possible. His goal isn't just lowering interest, it's eliminating debt entirely so he never has to think about it again. William follows what many investing advocates recommend. He pays every bill on time, avoids late fees, and invests $600 every month into a diversified Standard & Poor's 500 index fund. His reasoning is straightforward. If investments historically grow faster than most loan interest rates over long periods, investing earlier should produce more wealth. At first glance, both arguments sound almost impossible to disagree with. That's exactly what makes this debate so interesting. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Let's start by giving Dave Ramsey's approach the credit it deserves. His debt snowball method isn't built around squeezing every possible decimal point out of mathematics. It's built around human psychology. You begin by paying off your smallest balance first while making minimum payments on everything else. Once the first debt disappears, you roll that payment into the next debt, then the next, then the next. Like a snowball rolling downhill, your monthly payment grows larger and larger until eventually every debt disappears. Critics are quick to point out that paying the smallest balance first isn't always mathematically optimal. They prefer what's called the debt avalanche, where you attack the highest interest rate first to minimize total interest paid. And mathematically, they're absolutely right. But Ramsey's response has always been that people don't fail because they're bad at math. They fail because they lose motivation halfway through the journey. Small victories keep people moving. Now let's look at William's strategy. Historically, the United States stock market has returned roughly 10% annually over very long periods. although returns vary significantly from year to year and are never guaranteed. If your student loan costs 5.5%, while your investments might earn closer to 10% over decades, basic arithmetic suggests investing could leave you wealthier. There's another advantage too: time. Every dollar invested in your 20s has decades to compound. Compound growth simply means your investment starts earning returns on previous returns. Over enough years, that effect becomes incredibly powerful. Investing advocates also argue that money placed into retirement accounts can benefit from tax advantages and employer matching contributions, making early investing even more attractive. But their critics have a point as well. The stock market doesn't deliver 10% every year. Some years it falls 20%, sometimes 30%, sometimes even more. Meanwhile, your loan interest keeps showing up every single month without taking a vacation. And here's the nuance almost nobody talks about. This debate assumes people behave like robots. It assumes that if the market drops sharply, William calmly keeps investing every month without panic. It assumes Smith instantly becomes an aggressive investor the moment his debt disappears. In real life, neither assumption is guaranteed, and that one detail ends up changing almost everything. Now let's stop arguing theories and look at what actually happens. During the first year, Smith throws nearly every available dollar at his debt. His balances begin falling quickly, especially the expensive credit card charging 22% interest. Watching those numbers shrink feels incredibly satisfying because every payment produces visible progress. William takes a different path. He keeps making the required payments on all his loans while consistently investing $600 every month. His investment account begins growing, helped by regular contributions and normal market appreciation. By the end of the first year, William has something Smith doesn't: an investment portfolio. Smith, meanwhile, has something William doesn't: noticeably lower debt. Neither looks like the clear winner yet. Now we fast forward to the 2-year mark. William's investment account has grown to roughly $16,000. After accounting for his remaining debt, his estimated net worth sits around $18,000. Smith hasn't built an investment portfolio yet. In fact, someone looking only at his brokerage account might assume he's falling behind. But after relentlessly attacking his loans for 24 months, his lower debt pushes his estimated net worth to roughly $19,000. $1,000. That's the difference after 2 full years. Despite making completely opposite financial decisions, they're essentially tied. And that's the moment where most people draw the wrong conclusion. Investing First supporters look at Williams' growing portfolio and declare victory because they can actually see assets accumulating. Debt-free advocates point to Smith's stronger balance sheet and say this proves Ramsey was right all along. The reality is much more interesting. Neither strategy has truly separated itself yet, because the part of the story that changes everything hasn't happened. The real turning point arrives just 10 months later, and once it does, the race looks completely different. Here's where the story changes. Not because the stock market suddenly crashes, not because Smith gets a raise, not because William makes a terrible mistake. The turning point happens because one financial burden quietly disappears. 34 months after starting, Smith makes his final debt payment. That's it. No more student loan bill, no more car payment, no more credit card balance hanging over every paycheck. For the first time in years, every dollar that used to service debt is now free to build wealth. And this is the part many people underestimate. Smith doesn't suddenly start investing the same $600 William has been investing. He can now invest roughly $1,400 every month because the money that once went toward debt payments has been completely freed up. William, meanwhile, is still carrying more than $30,000 of debt. He's still investing $600 each month, which is commendable, but a large portion of his monthly cash flow continues disappearing into loan payments and interest. This is where momentum changes sides. During the first 2 years, William had what looked like the advantage because he owned investments while Smith didn't. From year 3 onward, Smith begins buying more than twice as many investments every single month. Think of it like 2 runners. One starts the race earlier but carries a heavy backpack. The other spends the first part of the race taking the backpack off completely. Once it's gone, they can run much faster. By year 5, Smith's investment account is catching up rapidly, despite getting a much later start. By year 7, the gap has largely disappeared. Then something fascinating happens. Compounding begins working on much larger monthly contributions. Every month, another $1,400 enters the market. Those dollars begin generating returns. Then those returns begin earning returns of their own. By the end of 10 years, the scoreboard tells a story that surprises almost everyone. Smith's portfolio lands somewhere between approximately $165,000 and $175,000, depending on market performance. William finishes with roughly $140,000 to $155,000. Remember what makes this remarkable. William invested for the entire decade. Smith invested for less than 7 years. On paper, that almost shouldn't happen, unless there was another variable influencing the outcome all along. That hidden variable isn't interest rates. It isn't investment returns. It's you, or more specifically, human behavior. One of the biggest assumptions in investing calculators is that you'll keep following the plan no matter what happens. Markets drop 30%, you'll keep buying. The news predicts another recession, you'll keep buying. Your coworkers tell you they're selling everything, you'll keep buying. Studies suggest most people don't. Research highlighted by JP Morgan Asset Management has repeatedly shown a striking gap between market returns and investor returns. Over long periods, the Standard & Poor's 500 index has historically produced average annual returns around 10% before inflation. Yet many individual investors have earned dramatically less because they buy after prices rise, sell after prices fall, or stop investing altogether during periods of fear. In other words, the market isn't usually the biggest obstacle, the investor is. That's why this debate isn't really math versus math. It's math versus behavior. Dave Ramsey is often criticized for ignoring perfect mathematical optimization. And in a spreadsheet, that criticism is fair. But Ramsey has never been trying to build the perfect spreadsheet. He's trying to build a system that ordinary people can actually follow for years without giving up. Debt freedom changes how people feel. They sleep better, they worry less, they have more monthly cash flow. They're less likely to panic every time the economy slows down because they don't have lenders waiting for a payment. That's the part many investing-first advocates rarely emphasize. A strategy that earns 1% less on paper but gets followed consistently for 10 years often beats the mathematically perfect strategy that gets abandoned after the second market crash. The best financial plan isn't the one with the highest theoretical return. It's the one you'll still be following when life becomes uncomfortable. Does that mean everyone should aggressively pay off every loan before investing? Not quite. There are situations where investing first genuinely comes out ahead. If your employer offers a retirement match, you should almost always contribute enough to receive the full match because that's essentially an immediate 100% return on your contribution. If your debt carries a very low fixed interest rate, around 3 to 4%, and you're already a disciplined investor who has consistently invested through previous market downturns, investing earlier can also make mathematical sense over long periods. The hardest decisions sit in the middle. Debt carrying interest rates around 5 to 7% creates a genuine gray area where personal behavior often matters more than formulas. So before copying anyone else's strategy, ask yourself one brutally honest question. When your investments lose 30% during the next bear market, will you calmly keep investing every month, or will you convince yourself you'll start again once things feel safer? Your answer is probably more important than any interest rate on this screen. Smith didn't win because debt is morally bad. William didn't lose because investing early is a bad idea. Smith won because eliminating debt gave him the cash flow, confidence, and consistency to invest aggressively for the rest of the decade without looking back. William followed a strategy with excellent mathematical logic, but carrying debt for longer slowed his ability to dramatically increase his investing power. That's the lesson most online debates completely miss. Building wealth isn't just about choosing the strategy with the highest expected return. It's about choosing the system you'll actually stick with when life gets messy, markets get scary, and motivation disappears. Because in personal finance, your biggest enemy usually isn't debt, inflation, or even a market crash. It's the version of yourself that stops following the plan. If you found this breakdown helpful, subscribe, because in the next video we're tackling another financial argument that divides almost everyone.